Corporate Finance presentation, stock split. Get ready, it's time to take our chance with Corporate Finance. Stock split. In prior presentations, we've been thinking about the dividend policy of a corporation, the policy related to whether or not the corporation is going to be distributing dividends to the owners of the corporations, those being the shareholders or stockholders, and if so, how much are they going to distribute it and how are they going to be distributed. The normal distribution would be a cash distribution. We also talked about then a stock dividend, which is related then to a stock split. So when you're thinking about a stock split, you want to kind of keep the stock dividend in the back of your mind, comparing and contrasting the two. So just an overview. Remember, when we're thinking about the dividend policy in general, we have the earnings that have been generated from the company. The company then has the option of either retaining them and then reinvesting them in the company to generate a return on them, or to distribute them to the owner in the form of dividends. Now, when we think about the distribution in the form of dividends, we usually think of cash distribution for the dividends, but we could distribute something other than that, like we could issue stock. We could issue stock to the existing holders. The issue with stock is that as you issue the stock, it kind of dilutes the value of the corporate, because there's no change to the underlying value. There's no change to assets. There's no changing to the liabilities. So when you look at a stock dividend, if you give it up to a certain point, it may have a separate or a different impact than if you say do a 2-for-1 type of stock split. A 2-for-1 type stock split, you would think, would have no impact on the value of the corporation. Assets, liabilities stay the same, and then the individual owners may not get any added value in that situation, because you would think just what would happen is that you would have two stocks instead of the one stock you previously had, but the value of it would be reflected in the market price possibly going down or being halved, resulting in you not in any better net position. Why then would a company want to do the stock split? A company might do the stock split possibly not so much to give value to the owners in the form of like a dividend, to issue, say, a dividend, but rather in order to adjust the market price. So say the market price is getting fairly high and the stocks are trading on the secondary market. In order to increase the value, it might be easier for them to do so if they had the market price a little bit lower, which is the area where most stocks are trading at. That might actually increase the tradability of the stock. A stock split can be used to do that. So stock split, company divides the existing shares of stock into multiple new shares to increase the stock's liquidity. So typically you're increasing the stock's liquidity by basically bringing the price down to that sweet spot where you're hoping that's going to make it more valuable to investors, because it's in that marketable area where people like to buy stocks possibly. So even though the number of shares outstanding increase by a specific multiple, the total dollar value of the share is the same compared to the pre-split amounts, because the split does not add any real value. So in other words, and we'll think about this with regards to the equity section. If you think about the equity section as a whole, there's no change to the whole equity section, but there's going to be more shares that are now out in the market. So we'll take a look at a quick example. Best way to run these problems or understand them better is to work example problems. We do have many example problems that you could take a look at. The most common split ratios are a 2-for-1 and a 3-for-1. This means that the shareholder will have 2 or 3 shares for every share currently held. So the current split would be in that ratio kind of format. 2-for-1 means if you have 2 shares, then, well, if you got 1 share, now you got 2 shares, right? If you had 2 shares, you got 4 shares. If you got 4 shares, then you have 8 shares. 3-for-1, if you had 1 share, then now you have 3 shares. So that's going to be the split kind of format, as opposed to, say, a stock dividend, where they're usually going to give you kind of that percent increase. The stock split accounting, no transfer of funds from retained earnings to capital accounts. So notice when you think about this from the accounting standpoint, it's different than a stock dividend generally. Because remember, with the stock dividend, we're assuming that we are giving something of value with this, like a 10% stock dividend or something like that. Therefore, we then will be decreasing the retained earnings as we assume we're distributing something, not cash, but something of value. With the stock split, we're thinking, no, we're not distributing anything really of value, because everything should basically even itself out. If you had 1 stock, now you got 2 stocks, but we would expect the market price to reflect that, and and be halved basically on the market price. So no more value, we're assuming, basically happens with the stock split. Therefore, we're not decreasing the retained earnings, representing the earnings that the company has accumulated that has not yet then been distributed out in the form of dividends. An increase in the number of outstanding shares. So obviously, this number of outstanding shares will increase. They'll double or triple or whatever the split is. A reduction in the par value. So how is this all going to balance out from an equity side of things? Well, we're going to make the other side of the adjustment to the par value, and therefore that's how it'll all balance out. And that'll make sense if you take a look again at example problems. It is different than the accounting for a stock's dividend. So impact of the stock split, the market price of the stock drops proportional to the split. This is what we would expect to happen, of course, noting that we don't have control over the stock market. The stock market does what the stock market has. We as the corporation did what we did. What did we do? Well, we issued twice as many shares. We doubled the shares out. We split the shares, or we tripled the shares, or whatever that would be. And so if you double the number of shares, you would expect the market, although we don't have control over it, but if it's taking the information as you would think it would and has everything else equal, it would then have the price of the shares, which is typically what we would expect to happen. The primary reason for the split is often to lower the price of the stock to a more popular trading range. So note that you might see the stock, go down to that sweet level that maybe is more popular, and if it was, then maybe it could even increase a little bit from there after the split, due to the fact that that's the point of the split. You're making it a more liquid area there in the price range, so hopefully it would be attractive to more people. So here we have an example before a 2-for-1 stock split and after the 2-for-1 stock split. We've got the assets, liabilities, and equity of the balance sheet. Our focus here then being on the equity section. So remember, of course, the assets equal the liabilities plus the equity. We can reformat this equation to be assets minus liabilities equals the total equity. The equity then representing the owner's value or the owner's claim to the assets of the company, as opposed to the debtor's claims of the assets of the company. That then is broken out between the owner's investments with regards to a corporation that represents the common stock for the issuance of the stock and the capital in excess of par, as compared to then the retained earnings, which represents the accumulation of revenue over time that has not yet been distributed to the owners in the form of dividends. Now note, if you have a dividend, then normally a cash dividend would be decreasing the retained earnings here because we're giving value to the owners. We're decreasing the amount that we have retained in the company from our earnings, paying it to the owners in the form of cash. The other side would be on cash. Cash would be going down. We also talked about a stock dividend, which is actually a little bit more complex than a split, and that's where the difference really comes into play here. Notice there's some overlap between the two because both of them result in us issuing more shares of stock, which has that dilution of the market value per share, of course. But when you think about a stock split, we say that there's no basically giving a value in that case because there's going to be a complete split that is taking place, as opposed to a stock dividend, in which case, because it's lower than a split amount like 10% or something, we believe that there is value that's going to be distributed for those dividends to the current owners. So therefore, in a stock's dividend situation, we're going to decrease the retained earnings by the value of the dividend that is going to be going out, and then we're going to have to offset that not with cash, but rather with the shares, of course, going up and the par value being affected, and then the capital in excess of par or paid in capital being affected as well. It's going to be a little bit easier with the split. If it's just a 2-for-1 or 3-for-1 split, this being a 2-for-1, then we're going to have the 100 shares, which are going to be doubled, in this case, to the 200,000 shares, because it's a complete split that's taking place. We're going to say because it's a complete split, there's no added value really that's going to the owners. Therefore, retained earnings is not going down. Instead, we're just going to have, in this case, having it, or divide by 2, the par value, so that we end up with the same common stock number over here at the 200,000. Now remember what the par value is. The par value does not represent what we issued the stock for, that doesn't represent the market price. It's basically an arbitrary number that makes it easy for us to go back and forth between the shares and the common stock total, because it stays even. It stays the same unless there's a split that happens here. And what we sold them for, what we actually sold the stock for, is included in the common stock and the paid in capital in excess of par. So these two numbers, in essence, represent what the company issued the stock for, although that amount per share could vary, because whenever they issued the stock, they're going to issue it for whatever the current value is. And so the par value here represents, breaks out the common stock in this more kind of even format with the set par value. So it's a pretty straightforward, easy calculation for the split then. We just take whatever the shares are, they've been doubled, and then we're going to do whatever we need to do to the par value to even it out. In this case, divide it by 2, halve the par value. So we end up with the same, with an increase to the shares, a difference in the par value, resulting in the total number being the same all the way across for the 200,000. No change to the capital in excess of par, no change to the retained earnings, and of course, no change to any underlying condition in the company, no change to assets or liabilities as well. So we also can think about the reverse stock split as we are here too. So that would be just the opposite of the split. We're going to reverse it. This would be less common, far less common, and hopefully it's not, it would usually be a negative kind of indication to have the reverse stock split. So a stock split, you'll recall the main reason for it would be possibly if the price is getting too high, hopefully because the company's doing good and the price is valuable, but it's outside what you would think the optimal range would be. You could do a stock split, lowering the price hopefully into more of that optimal range. That's usually kind of a good sign. If you're doing the reverse stock split, you would think the reasoning or the rationale would be the opposite, meaning you're going to reduce the amount of stocks that are out there. That's going to increase the stock price, hopefully to that sweet spot that you're looking for. But the fact that you have to do that doesn't seem good, right? So it could be a negative indication to the market. And they might do it just so they can stay on the exchanges, because the exchanges might have some kind of regulations in terms of how high the price needs to be in order to be on the exchange. So you could be forced then to do a reverse stock split, which again might not be perceived as positive. So this consolidates the number of existing shares of the stock held by shareholders into fewer, proportionately more valuable shares. So you can have fewer shares reversing the stock split, and so therefore the shares you would think or hope would be more valuable after that. The reverse stock split does not impact a company's value directly. So once again, no impact, just like the normal split. The reverse split doesn't have an impact on assets or liabilities. However, it often signals a company in distress, as it is often an attempt to raise the price of the stock. So clearly they're trying to raise the price, which is not, if you're trying to lower the price to get it to that marketable point, that seems like a kind of a good thing. If you're trying to raise the price, then it seems like you shouldn't have to do that. Could be a negative indicator. An attempt to remain relevant and not be delisted are the common reasons for corporations to use a reverse stock split. So if the price goes down too much, if you go over whatever the regulations are for the market to be listed, then of course that could force you into that situation of needing to do the reverse stock split.